Hello, everybody. This is True Demon, the Devil Stockbroker, and I'm giving a brief update on BBIG just to react to the price action that we're seeing here and give an update on the potential for a gamma squeeze as well as the current uh, current prospects for a short squeeze. BBIG's run up starting on January the 12th and reaching its peak on the 18th at $5.50. We've since consolidated at the top and dropped out at on January 19th and broke down below this megaphone pattern. So the downtrend that we're seeing currently is putting us in a bit of a bull channel right now, which so far has ended in consolidation, and we've bounced off in this double bottom pattern off of 392. Currently in post-market trading, we're at a price of $3.69, which is will place us down here below support. If we do end up gapping down, then we may end up filling that gap tomorrow. There's no way to know for sure, but I'm just going to point out something that I noticed that's rather extreme data. So January the 19th, the 18th and the 19th are significant dates. What I'm showing you right here is this is our short exempt squeeze picker that is analyzing the short exempt volume. We base our thesis on this data because short exempts seem to show an involvement of market makers in certain stocks, especially when there's a high amount of volume being traded in the options market. Now, short exempts are something we've talked about often, but for those who don't know, short exempts are a tool exclusively used by market makers to fulfill buying orders during frenzied or panicked markets, or when no shares are available to borrow on a stock and they cannot locate the shares. Market makers define their own rules for taking a short exempt, and they only have to justify to the SEC and FINRA for taking short exempts when asked. There is no regulation on these, and it's part of the REGSHO or regulation short rules of the SEC that essentially the market makers only have to justify whenever asked. But the purpose of short exempts are to fulfill buying orders in order to keep the market moving and provide liquidity at the expense of the market maker. In reality, what ends up happening is short exempts get used to fulfill buying orders without having to take a borrow because they're exempt from the locate rule. So most of these, we suspect, are naked short. Essentially, they never found a borrower, and because the market is moving so quickly, they use this excuse and are not forced to they're not forced to justify themselves unless the SEC comes knocking on their door. And of course, it will be too late after the fact because options expire tomorrow. Now, the data for today is not present yet, so that's why you see zeros here on this first row. But given the volume that we've seen drop out, we're expecting there to be also a drop in short exempt volume. Here's the important thing about this data. Short exempts, if they are naked short, must be located within 6 trading days in order to not fall into violation. If that happens, then the market maker gets into trouble with the SEC and they can be restricted from trading the stock. It's built into the trading system that they're forced to reconcile these within 6 trading days. At least this is what the rules say. What may be happening in reality might be a totally different story. However, what we've noticed is that fares to deliver usually spike when short exempts 6 days after short exempts spike. This trend has continued looking back into the past on stocks such as AMC, SPRT, and so forth. This particular amount of short exempts is inordinately huge, that despite the dropping volume and the dropping short volume, the short exempts are extreme by comparison. If we go back to our trading view chart, so on the 30-minute, we see the on-balance volume is pretty extreme and jagged. If we go to the 4-hour chart, we'll get a slightly different look and feel to this. So the OBV lifting like this is a sign of buying pressure. Mostly the volume has been towards the buy side, just based on the volume candles and the closing price being above the open price. So because of that, the OBV lifts significantly. And what we see in the past is that the OBV lifting will lead to massive price action in the future. This is just the OBV creating a small bump, which relative to our current trading price would have been these few trading days here. Based on the volume that we saw, we should be trading somewhere up in the $6 to $7 range, or so we would have suspected. However, market makers stand to lose an extremely large amount of money if this were to come to fruition. Going over to bar chart for just a moment, we can see there's a massive amount of open interest on calls above the $4 strike, and this is certainly brings to mind Max Payne theory. If market makers are able to keep the price below $4, then they stand to gain a great deal of money. However, if the opposite is true and the price lifts above $5, then they stand to lose much, much more. Compound that with the fact that all of these short exempts were taken and they must be delivered. And in order for market makers to not get absolutely nailed on the price, they need to cover these at a better price than what they opened them at, considering that they opened most of these between $5 and $4.53 based on just the open close price on the 19th. It may be that they open these at higher prices than that, but essentially, if they cover these in the short term now, then they will effectively get away with it. They'll be able to cover at a better price, and they'll have used these essentially naked shorts to drive the price down low enough to cause those options to expire out the money, and the price will have been slammed down enough to kill the momentum, and they can essentially cover at whatever price they dictate by their due date. Let's speculate on a theory of what might happen if market makers don't get their way. If market makers are not able to control the price and they do not close the price below $4, if, say, retail was to bring in approximately, let's just say, 140 million shares worth of buying volume before the close tomorrow. If 140 million shares of buying volume were to push the price back up, we would easily be trading above a $5.50 range. This would bring more than 200,000 call options in the money. Effectively, that equates to about 20 million shares, or a little over 25% of the tradable float on BBIG. In addition to that, if that price were to happen, market makers would be put in a position where they're forced to cover their failure to delivers that are caused by their short exempts that they used to push the price down to this current level. And they would be forced to do it at the current trading market price. If that were to happen, then they would be forced to buy at the market. So after the price had already lifted to $5.50, not only would all of those options be expiring in the money, effectively creating the situation where a gamma squeeze is entirely possible, market makers would also have to add fuel to the fire by buying themselves enough shares to cover their failures to deliver before the price got away from them. This can only happen if literally hundreds of thousands of shares get bought in a matter of hours between now and Friday's close. It would take probably about $400 million worth of buying pressure alone to do this. I'm not saying that it's impossible, but I am saying that it is a tall order. And the reason why I'm creating this video is because I want to highlight that the algorithm that we are trading on here is entirely based on detecting fraud in the market. That's what we're doing with this. We're detecting fraud in the market, and we are detecting when market makers are losing control. The only way that market makers can lose control is if retail ignores their fear instinct to run when a stock is trading down and the price is falling. And because market makers prey on that fear and their algorithms are exceedingly good at invoking that kind of fear, that's why their system works. And it's why they keep stealing from people so often, every single day. So, this is not financial advice, and I'm not a financial advisor, but because of where I stand on market manipulation and the lack of transparency in the markets, I intend to buy every share that I can spare, $1 for between now and Friday. And if enough trading volume were to push this stock to the buy side, then we could very easily see the stock price skyrocket from here. But this is not an endorsement or any kind of call or pick. I'm essentially just I'm making this decision because of I don't know. You could call it revenge trading or whatever you want to call it. The only thing that I know is that any options bought between now and Friday, unless it's backed up with shares, then it won't matter. And if the gamma squeeze fails here, then it would be very difficult for it to be replicated in the near future. Because this was the week where the momentum would be the strongest, and we saw how dangerous it was to market makers. There's already a ton of shares that have been exercised, or a ton of calls that have been exercised that brought so much shares into retail hands and institutions' hands. But in order to create the kind of squeeze that was being anticipated here, will require the entire market to do something during a red market that nobody wants to do. So I'm going to go against my inner instinct, and I'm going to ignore the fear response, and I'm going to purchase some shares tomorrow. That's my personal trading plan, and I don't advise anybody to make any decision except one that they feel is right for them based on their own personal trading strategy. Kat, do you have anything to add?
Sorry, I was having a little trouble there. No, not at the moment. I mean, I just to your point, I found it it's just incredibly odd the price action. I mean, the run-ups and the price action and pre-market and post-market is just odd in and of itself, even if there was news, considering how it reacted during the actual trading hours. But considering there are no news catalysts and it's just doing all of this nonsense, like it just like there has to be a further explanation, and it just kind of speaks more to the theories that have continued to evolve as far as the manipulation.
Yeah. I have to agree that in this scenario, the only real explanation for the price action turning around as quickly as it has in the absence of enough selling pressure, that short exempts are essentially being used to fulfill buy orders without having to go into the market to purchase them on the exchange. For those that don't understand what I mean when I say that, essentially, if you're going to your broker and you're asking to purchase shares, and your broker goes through a market maker to fulfill that buying order, then what the market maker is supposed to do is they're supposed to go out into the market, go find a better price, and then give you that difference. And then they make a micro profit, like less than a fraction of a penny on every single transaction, which is why they like to get as many transactions as they possibly can. But in the case of short exempts, because they're exempt from the locate rule, the market maker doesn't have to go into the market to go and fulfill that buy order. They can just simply say, we're going to deliver you this share, and then extend an empty hand and say, we don't have it yet, but we'll give it to you in 6 days. Tee hee hee. And then between that time and the 6 days, they will use this in order to suppress the buying pressure. Effectively, they use this so that they do not create any buying pressure in the market themselves. They simply deliver phantom shares to the person who is asking to buy, that if that person had gone to an exchange instead, if they had gone directly to the NASDAQ and said, I want to buy BBIG shares, and then found somebody selling on the NASDAQ and purchased those shares, that isn't what happens in this situation, because the market maker has their own internalizers and their own inventory, and they can simply deliver a share that they promise you exists somewhere in the ether, and then they go give it to you. But they don't actually give it to you. They don't deliver it to you through the clearinghouse and send it to your broker's inventory to market in your name until 6 trading days later. And because that buying pressure isn't happening, then the only thing that's happening is selling pressure, which the market maker, of course, is applying directly to the stock because they're incentivized to do so. They control the order flow. Ergo, if somebody wants to sell a share, then the market maker can simply send that directly to the exchange and say, hey, we have somebody who wants to sell a share. Let's go directly to the exchange where it has the most pronounced effect on the national best bid and offer and push the price down. If you do that enough, and let me just illustrate how ridiculous the climb is. Look at what BBIG was trading before it had any interest whatsoever. The short exempts were less than 10,000. And I assure you, if we go further back into time, back into December of last year, it will still be below 10,000 short exempts every single day. Lo and behold, when the price starts to go against them, the short exempts get inordinately high, just completely crushing the price by suppressing the buying volume and pushing as many buy orders out of the eyes of the NBBO as possible, so it has no net effect. And for those who are asking themselves, well, what the hell can we do about it? Then the answer to that is to go through a direct market order, which is how I do all of my share transactions now. If I'm going to buy shares, then I'm going to buy them directly from the NASDAQ or the NYSE. In order to do so, you would go through brokers such as Fidelity or TD Ameritrade, which allows you to make a directed market order and then send that market order directly to the exchange of your choice. In this case, the NASDAQ is what BBIG trades on, so that would be the exchange you select. The only problem is that most people don't have a real broker. Most people have something like Robinhood or Webull or there are a couple of other ones that the names escape me, but brokers such as those, which take payment for order flow, they will send it to whatever source, i.e., a market maker, can give them the best payment for sending that order flow in that direction. So the brokers are getting a payout by sending as many of your orders as possible to a market maker because that's how they make a lot of their income instead of through commissions. And in the end, retail gets reamed because the market maker is the one who's keeping all of the money that would be made by widening the spread. The broker's making money because they're getting paid off by the market makers, and the exchange doesn't see anything, so it doesn't matter what direction you are hoping the price is going to go. It's only going to matter whatever the market maker decides the price is going to go. So that about sums up all my frustrations, and I'm sorry to leave it on such a somber note, but that's effectively all the DD that I have here on BBIG for you today. I am still overall bullish on the stock, and I do think that a squeeze is possible, but I think that in order for a gamma squeeze to take place, then it's going to require retail to actually look at this in a way that most people are not willing to. It actually will require people to ignore their own instincts, and for day traders and retail shorts who are looking to make a profit on every other swing to simultaneously look at this and say no to the manipulation and say that we're going to go against what the market maker is pushing this stock price in. And if that were to happen in mass, in unison, then absolutely the price could go parabolic. It's absolutely possible. It happened with AMC, it happened with GME, it happened with SPRT. With BBIG, it is going to be difficult, and I'm not shy to explain that to people or share the reality of the situation. And although that may hurt my own personal trading strategy, I'm always going to make the effort to be honest with everybody and let them know just how serious the situation is. But that's what Hell's Trading Floor is all about. We're here to explain and educate on what is happening in the markets, and our mission is to inform everybody and arm them with the knowledge to make good, solid trading decisions that are best for them. If you are interested in joining us and being a part of this community, you can check us out on discord.gg/Hell's Trading Floor, or take a look at our Patreon at patreon.com/The Devil's Broker. Thanks very much for watching, and have a hell of a time in the markets.